This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 7 videos on protective stops. I'll begin by answering the obvious question, why use stops? And the answer is to protect yourself mostly against yourself. A stop is useful in determining what your position size would be. Since the distance to your stop is a measure of your risk, that allows you to determine what your appropriate position size should be. Experienced traders always have protective stops in the market, not just in their heads. The purpose of a protective stop is to protect you and to protect you against many things. For example, there may be some surprise move that is much bigger against you than what you expected. There may be problems with your computer, with your internet connection, problems with your broker, problems with the exchange, all kinds of problems. And a stop does give you a high degree of protection, not absolute, but a very high degree of protection. Most importantly, a stop protects you against yourself. Traders often get emotional, especially when they're starting out, and they get hopeful. The market starts to go against them, and they don't want to take a loss. They keep the stop in their head, not in the market. The market goes through the stop in their head. They create a new fictitious stop, and the losses just keep growing as the trader never exits the losing trade. A stop means that you have to stop what you're doing. It's absolute. You get out and take the loss if it's a loss, but you get out. Don't question whether you should get out, whether you should move your stop. You put your stop where you put it because it made sense at the time you put the trade on. And if the market's going against you and you're now questioning whether your stop is in the correct place, you're probably getting emotional. And that's the very thing the stop is designed to prevent. It's designed to prevent you from allowing emotions to influence your decisions. So let your stop be hit if it's going to be hit and don't move it. Simply get out and wait for the next signal, knowing that losing is part of trading and the protective stop keeps you from losing too much. I think it's very important to understand that when you're managing a trade, it has nothing to do with where you entered the trade. It has only to do with what the market is currently doing at the moment. Every instant that there's a new tick on the chart, up or down, you have new information. And the management is based upon that new information, not based upon where you entered. It doesn't matter if you buy here or buy here, the stop is still there. For example, you could buy any one of these bull flags. Anytime you enter the market, there are usually several reasonable choices for stops. For example, if you buy here or here, you could put a stop here, arguing that you have a high 2, high 1, high 2. You do not want it to fall below the bottom of the high 2 bull flag. However, you have a strong reversal up, and this is a major high or low, a breakout to a new trading range high, not a breakout to a new high in the chart, but a strong breakout to a new trading range high. This is also an appropriate stop. If you buy here or here, this is a good place for a stop. This is also a good place for a stop. Let's say the market started to go up and you're at this point, or if you buy here, most traders would put their stop below this low. This is a major high or low. We have a strong breakout and a new high. Anyone who is holding along after this breakout takes place, he would have his stop here. It doesn't matter if you bought here, or if you bought here. At this point, the stop for all of those traders probably is going to be right here. Again, it doesn't matter where you buy. Stop placement is determined by what the market is currently doing. And once you've had a strong breakout to a new high and a bullish channel, it's usually better to put your stop below that low. After this strong breakout and follow through, if the market falls below that low, then your premise of a bullish channel is probably no longer valid. The market then would either be in a trading range or possibly even in a bear trend. And therefore, since your premise is no longer valid, you get out. Again, it doesn't matter where you bought. If you bought up here, if you bought down here. Once you've seen this, and the market's now up here or anywhere in here, this is a good, reasonable location for your stop. We have a higher low major trend reversal, bear trend, bull breakout, higher low. You can also call it a head and shoulders bottom. We have a breakout, 50% pullback, a strong breakout, 2 legs down, 1, 2. Second entry buy, you can call it a wedge, 3 pushes down, high 1, high 2, high 3. In any case, you have a very good looking buy signal bar and a higher low around a 50% pullback of this leg up. It's a reasonable buy. A lot of traders only think of stops as either being very wide or very tight. Some traders use other terms as well. For example, a trader buying above here, he could put a stop here, which is fairly tight. I would call that a price action stop. You're placing the stop based upon the current price action. You have a wedge bull flag, a high 2 at the second entry buy, a very strong bull signal bar. That's a reasonable place to put your stop based upon the current price action. So is this. This is a major higher low, a break to a new high above this high, and a strong rally. The market should not fall below this low if it's in a bull trend. If it falls below this low, then the market's not in a bull trend. It's either in a trading range or possibly a bear trend. Some traders like to use a money stop. For example, they might use a stop that is 10 ticks below their entry price, or 10 pips below their entry price in a Forex trade, or maybe $100 below their entry, maybe 10 pips below or 10 ticks below the low of the signal bar. Some traders will look to scale in below. But anyway, the point is a money stop is based upon the number of ticks or pips or a dollar amount, rather than simply based upon the price action. Other traders just use very wide stops, and sometimes they'll be based upon the price action. For example, they might put a stop below the entire bull trend all the way down here, or they may use a stop that's several $100s below their entry price, or 30, 40, or 50 ticks, 30, 40, 50 pips below their entry price. And that is an example of a wide stop, which could be a money stop or a price action stop. You could put a stop based upon a measured move. We have a strong breakout. It should lead to a measured move up or down. If the market starts to reverse, some traders will want to give the market room in case the market forms a trading range instead of a bear trend. A logical location for the stop would be just at or below a measured move down, usually just below a measured move down. Once the market starts to go your way, you raise your stop in a bull trend, and that is called a trailing stop. If your stop was initially here, and we got a breakout here, a lot of traders will put their stop below the most recent major higher low, which is right here. That's called trailing the stop up. After every strong breakout to a new high, raise the stop to below the bottom of that major higher low. Lots of decent stop entry buys in a bull trend. Most experienced traders will get out below the bottom of the most recent major higher low. Is this a major higher low here? I don't know. The breakout's not all that strong. Here we have a decent bull bar, decent follow through, and then additional follow through. This is, I think, a fairly important price, as is this and as is this. These are all major higher lows here, here, and here. Most bulls, no matter where they bought, if they were still long up here and we had this surprise bar, they would have a stop below this bar and they would get out right here. Some instead would have a stop down here or here. Once they saw this big bear bar, they would conclude the bear bar was big enough so that we would get at least a second leg down, and they would get out on the close of that bar. We have a spike and a pullback and then a channel. A spike and pullback bull trend. A lot of traders expect the market to come down to the bottom of the channel, maybe a little bit below. They'll put a stop several ticks or several pips below the bottom of the pullback, expecting the market to come down there. Other traders will assume that spike pullback channel will lead to a trading range, and a trading range can trade down here, but it will have a rally afterwards. They'll instead use a wider stop below the bottom of the bull trend instead of just below the bottom of the channel, thinking that the market might fall below this low, but as long as it stays above this low, it probably will enter a trading range, and therefore they could exit higher. If they're long from any of these entries and they hold through a pullback here betting on a bounce, they could get out with a smaller loss if they bought up here, or with a bigger profit if they had bought down here. Everyone is naturally very hopeful, very understanding, and very forgiving, and they assume that the market will behave consistent with those feelings. But that's not the way markets work. A beginner often thinks of a market as a person who does not realize that he is making a mistake. I think it's natural for a beginner to think of the market as a person. In every other aspect of life, you're interacting with people, and now you're interacting with the market. You tend to personalize the market and think of it as a person. And a beginner, when he sees something like this, thinks the market, is making a mistake, but he does not realize what a terrible mistake he's making. People tend to be forgiving, and a beginner has a natural inclination to give the market a chance to fix its mistake, redeem itself, and become a good person again. Maybe he'll look at this as a bear trap, a failed bear breakout. He'll come up with all kinds of reasons to deny that this is real. It's still above the bottom of the channel. It's still above the bottom of the bull trend. Maybe a beginner who is not using a stop will give the market more time. Maybe the market will see it's making a mistake and it'll go back up. Now we have a second bar, and it has a bear body. That is follow through, and it increases the chances that this is real and that the market's going to go lower. Let's take a look at a beginner who bought right here, and now the market's down here with a big bear breakout, well below his entry price, and we have a follow through bar as well, another bear body. The beginner does not want to exit a trade too early because he'll feel like a loser, and he knows that experienced traders are making money all day long. The beginner starts thinking about the personality traits of good traders: discipline, they're positive, they don't worry about losses. The beginner wants to think like a winner. All he's doing is trying to justify holding on to a losing position, a position that he really needs to exit. He doesn't want to look at this as a reversal with follow through, and he doesn't want to believe that the market now favors the bears, the probability favors the bears. He just simply denies what's in front of him. We have a spike pullback channel, we have a huge bear breakout, and a follow through bar. The odds are we're always in short, which means the probability is we're either going to go sideways or down. And the first rally, traders will sell it and will go down. So he bought here, he sees the bear breakout and the follow through bar well below his entry price. He's still hoping that there's a chance that this will be a higher low and lead to trend resumption up, even though if he was objective looking at this, he'd say, no, we're going down, or at least we're going sideways. People want to be virtuous. Again, they want to personify the market. They want to think of the market as a person. And the beginner wants to allow the market to fix its bad behavior. The beginner wants to be forgiving because being forgiving is virtuous. And he wants to see himself as a good person. Again, these are just all the kinds of thoughts and feelings that beginners have to justify staying in a losing trade. They're all wrong. At any given instant, there's always a reason to be long and there's always a reason to be short. But sometimes one side has a terrible probability, a very low probability of success. The beginner who bought up here and now is sitting with a loss, he wants to pretend that he's being objective and that he's analyzing this just the way any professional trader would look at it. He comes up with all kinds of plausible reasons to justify his staying long. There's follow through, but it's only a doji body, and it's still a higher low above the bottom of the channel, above the bottom of the spike. Maybe if he holds on, he'll get a bounce that will allow him to get out with a smaller loss. Maybe it'll bounce back above his entry price, and he'll be able to get out break even. The beginner is going to come up with every possible thing that he can conceive of to avoid thinking about the real reason why he's holding long when the market's clearly bearish. Why do you think the beginner is holding long? He bought here and now the market has done this. Why is he holding long? There's one reason. He's afraid to take a loss, because if he takes a loss, he sees himself as a loser, and if he takes enough losses, his account will slowly disappear. He's afraid of the death of his dream of becoming a successful professional trader. That is the fundamental issue, and he's coming up with all kinds of reasons to avoid that thought, but that is his thought. He's afraid of death, the death of his dream. He's got to get over it. When you trade, you're going to lose. You're going to lose some of the time, and as you get better, you lose less often, and your losses become smaller. But even experienced traders are going to lose some of the time, and you can't dwell on the losses. You have to make the correct management decisions, and you have to rely on your stop. The beginner's still long. He sees a bear bar, a doji bar, a bear bar, a bull bar, and he's arguing, oh, consecutive sell climaxes was still a higher low. maybe we'll get a 50% bounce and I can exit with a smaller loss. It's a mistake. It's all a justification. He's just simply denying what's in front of him, hoping that he will not be forced to take a loss. Maybe he can lower his stop down here, the next logical support area, the bottom of the bull trend, spike pullback channel. He's thinking calmly that, okay, I want to stay objective. I want to think about this the way the pros would think about it. And the pros certainly could manage their way out of this trade and avoid a loss. But that's not true. Pros take losses. When the market is going against them and their premise is no longer valid, we take our losses. You know, the pros know when they're wrong, and they just get out with a loss when they're wrong, and they don't worry about it. They just accept that nothing is 100% probable. Even the best things are only 60% probable. That means you're going to be wrong 40% of the time. That's part of the business. When you're wrong, you exit. Now we've had a breakout to a new low of the day, 4 consecutive bear bars here, consecutive sell climaxes. It's probably going to collapse into the end of the day. The beginner thinks, okay, I better just admit that I'm wrong and take my loss. He thinks he traded just like a pro. He gave the market room. This is just one of those situations that even an experienced trader would lose money. And he finally ends up taking his loss on the breakout to a new low. We're clearly in a strong bear trend. On the other hand, when I look at this, I'm thinking, big bear bar, probably at least a small second leg down. Another big bear bar, looks like probably a little bit lower, but now we have consecutive sell climaxes here, here, a 2-bar sell climax here, another sell climax here, and look at the follow through, a doji, a bull bar, a bull bar. This looks like a bear leg in what will become a trading range. So we'll probably bounce soon. Also, it's an expanding triangle, low, low, lower. Not a good shape, but still an expanding triangle. And it's also possibly a breakout below a developing trading range. Beginners looking at this as the end of the world, and he cannot just stay long anymore. He bought high, and the market's now very low. He just lost way too much money. But that's not what an objective, experienced trader is going to see. He's going to see a series of consecutive sell climaxes and a new low. This is probably a bear leg in what's going to become a trading range. And therefore, traders are expecting 10 bars, 2 legs up pretty soon, and they're starting to look to buy. And this is what we got. The beginner exited his long down here and the break to a new low, and the experienced traders looking at trading range price action, spike pullback channel, and probably a conversion into a trading range. And therefore, once the channel is going on and has had several legs down, it probably is going to go up. The opposite of this, spike pullback channel, after several pushes up, it's probably going to go down. No one left to sell at this price, and the weak bulls finally gave up. The bulls who bought all through here and did not get out when the market told them they were wrong, they finally give up. The strong bulls are never going to give up. They're going to hold and buy more as the market goes down. The bears who did sell up here or through here are expecting the market to bounce soon as well, and they're taking profits. So the strong bears are taking profits. They want to sell higher. No one left to sell at this price, and the result is a rally. Strong bears sold here, take profits, and do not want to sell again 1 or 2 bars later. They want to sell high. And therefore, there's a buy vacuum. There's an absence of sellers at this price, and the market gets vacuumed up to prior pullbacks, this high, maybe even this high. Spike channel down, consecutive sell climaxes. Probably we're going to get 10 bars, 2 legs sideways to up, maybe more. We have a micro double bottom here, a second entry buy here, a bull bar here. Should get at least to this high, probably to that high. This is a reasonable buy, so we should get at least to that high. Bulls will buy for a test of that high, test of this high. Where you put your stop determines how much money you're going to risk. The amount of money that you're willing to risk always determines how big a position you should take. You never want to risk more on any trade than you would on any other trade. Whenever you're looking to enter a trade, you first look where your stop has to be. That determines your risk. That also determines how big a position size you can take. You can therefore adjust the size of your position based upon where the appropriate stop would be. and you rely on your stop as long as your premise is valid. If the price action tells you that your original premise is wrong, get out, take the loss. Do not wait for your stop to be hit. On every trade, the total dollars that you're risking has to be no bigger than your comfort level. If you're thinking too much about the size of how much you can lose on a trade, you're not going to trade properly, you're not going to manage the trade properly, and you're going to lose money. You cannot be thinking about money, and therefore you have to trade small. You should always trade the I don't care size. Trade small enough so you really don't care very much if you lose. That way there, you can manage the trade properly and make objective decisions and do what those decisions tell you to do. For example, if you buy here a bull flag, bull breakout, a wedge bull flag, high 1, high 2, high 3, a good place for a stop is either right below the bottom of the wedge or below the bottom of the most recent bull breakout, a major high or low. The risk is from your entry price to the stop. That's your initial risk at least. And let's assume this is your average risk. Let's say this is as much as you're willing to risk on any trade. If this is your average position size and this is your average risk, you're buying in a strong bull trend, the probability is that the market's going to reward you with a profit that is at least as big as your risk. If you're buying here and this is a logical stop, 60% chance the market's going to go up that same distance before it gets to your stop. Because the probability is high, you can take a reward that's equal to 1 times your risk and still have a good trader's equation. The math makes sense. We're buying here, using the appropriate stop, and then taking partial or full profits at that same distance up. It's more likely that the market's going to go that distance up before it goes that distance down, and therefore exiting with a reward equal to your risk makes sense. Let's say you're still long at this point. What do you see? You see a spike pullback channel. It's a nested wedge. Spike pullback channel, spike pullback channel. We have a nested wedge, different ways to draw the 3 pushes up. You have a series of buy climaxes. 1, 2, 3, 4, 5, 6. I have 4 written here. 1, 2, 3, but it's really 5, 6, 7, 8. A lot of consecutive buy climaxes. The odds are we're going to get a pullback pretty soon. The bears theoretically will sell below this bar, betting on at least 10 bars 2 legs down. A lot of traders will not take the first sell. A lot of bulls, however, will exit on a second reversal down after a nested wedge top. Many of the bulls will get out here if they did not scalp out earlier. Aggressive bears would sell either here or here. Other bears would wait until they see the big bear breakout or follow through and then sell, expecting at least a measured move down. Again, some bears will see the big bear breakout, see the bear bar on the next bar, and then sell the close, expecting a measured move down. If you take that short, your stop at a minimum is above the top of the bear breakout, the bear reversal, the bear sell climax, whatever you want to call it, or above the top of the bear trend. However, look at the size of the risk. I said if this is your average risk for your average position size, now if you take this sell, the risk is twice your average. And that means if you take this sell, you have to reduce your position size because you want the total dollars at risk to be the same. If your stop is twice as far away, you have to trade a half of your normal position size, maybe even less. This stop location determines the size of the position of your short. Strong bear breakout and follow through, 60% probability you're going to get a measured move down based upon the distance to your stop. 60% chance if you sell here, the market is going to go down here, this distance, before it goes up here. Because it's a 60% probability of reaching a reward equal to your risk, you can take all of your position off or part of your position off at 1 times your initial risk. This is the distance, here's the same distance, a reasonable location to take profits, and you can see a lot of traders did take profits here. Again, if you sold here and used the correct stop, your risk is twice normal, your position size is half normal, but because your risk is twice normal, you need a profit that is twice normal as well to make the trader's equation positive. I talked about the reason why traders use stops. Protective stops are to protect you against anything unexpected, and if you're a beginner, they're very useful to protect you against yourself. The stop's location determines how much you have at risk, and that determines your position size. If the stop is twice as far away as you normally have it, you have to trade a position that is half of your normal size. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This was the first of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 7 videos on protective stops. I want to talk a little bit about what happens after a stop is hit. I also want to talk about the importance of using the correct stop. There are often several choices for a protective stop. One that is too small or too wide is usually a losing strategy. It's a trading range. It's a head and shoulders bottom. It's a high or low major trend reversal. Both are always part of a trading range. You can call it a triangle. You can call it a double top, a bull breakout above the double top, and therefore a failed breakout above a double top is a wedge. So if you want to call it a wedge, 3 pushes up, 1, 2, 3, you can. I would call it a triangle. Whenever the market's in a triangle, 50% chance you're going to get a successful breakout to the upside, 50% chance you'll get a successful breakout to the downside. Therefore, it's reasonable to sell here. We have a double top here, and now we have a small double top within the double top. The bears see it as a bear flag, a bear trend, and then a trading range or a triangle or a wedge, a decent sell signal bar. This is an appropriate sell right below the low of that bar, and you get filled here. A logical stop is above this small double top, which is also above the top of the triangle. This is what you got. A lot of traders would look at this and say, okay, that's a pretty strong bull breakout, and we have 3 pushes down. 1, 2, and then a bull bar, and then 3, another push down. And we have a pretty good buy signal bar after a decent buy signal bar here, around a 50% pullback of this breakout. Therefore, this is a wedge bull flag, and the market's probably always in long. Instead of going down, we might be going up. Most bears would exit above the high of this bar, and many bulls would buy, betting that we're going to rally. The bears who did not exit here, the ones who relied on their stop, get out right here, just above this high, this double top. Bulls buy as well. They'll buy just above this double top, knowing that the bears will have stops there, the bears will give up. They'll buy the close of this bar. We have a bull breakout bar here, a follow-through bar. They'll buy above the high of this bar. They'll buy above the high of this pullback bar, a high 2, high 1, high 2. Now we have a micro double bottom, up, down, up, second entry buy, another buy. Bulls will buy for any reason in here, looking for a measured move up based upon the height of the trading range. At this point, we're around a measured move up based upon the height of the trading range. Here's the breakout, the pullback dipped a little bit below it, so it's a negative gap. And here's the measured move projection. It's also a wedge, and it's also a big double top with this top of this bear trend. Slightly higher high double top, but it's a double top. Some bears will take that sell. It's not yet high probability. We have too many bull bars, and you don't want to be selling below a bull bar. This might be a little bit early. It's an okay sell, but low probability. A bear selling here might put a stop here, betting that if it goes above here, it's breaking above a wedge, and therefore a 50% chance of a swing up. Other bears might think, okay, we're getting consecutive buy climaxes. If this is not the top will probably come pretty soon, so maybe you just use a very wide stop and stay short. The bears who did use the wide stop did not get stopped out, and they were able to hold short for the swing down. The bears who did sell here and got stopped out here could sell again either here, or wait for this, betting that all of those entries have a reasonable chance at making money, especially selling here or here. Again, the bear who sold here, if he got stopped out, he's going to look to sell again. A failed breakout above a wedge, a second entry short below that bear bar, or on a strong reversal down here. It's not a big problem getting stopped out. If your trade ultimately proves still valid, you can always sell again. For every trade, there are several choices for a stop, and usually 2 or more of the stop choices are reasonable, and therefore you could take either one. Make sure to always choose a reasonable stop. We have a huge bull breakout of a tight trading range. This bar is maybe 5 times bigger than the average bar, and therefore you cannot use an average size money stop. You have to allow for a deep pullback. If you buy this close, for example, or if you buy above the high of this bar, your stop is all the way down here. If you buy this close or above the high of this inside bar, you get filled right here. You have to use the correct stop. The most logical stop is below the bottom of the bull breakout. If the market falls below the low of this bull bar, then your premise of a bull trend reversal or a bull breakout is no longer valid. Therefore, it's a major low. We have a strong bull breakout, 4 consecutive bull bars closing at their highs and a new high. At any point from here onward, this is a reasonable stop. You can trail your stop from here to here. So you move it from here to here. That's called trailing your stop or raising your stop. You want to keep your stop below the bottom of the most recent major high or low, because as long as the market continues to have strong breakouts to new highs, it's in a bull trend. If it falls below one of those major higher lows, then the premise of a bull trend is no longer valid. The market is then either in a trading range or a bear trend. Another strong breakout to a new high. At this point, anywhere up in here, the stop now is below the bottom of the most recent major high or low, bottom of this strong bull breakout. Another strong bull breakout, 3 consecutive bull bars closing near their highs. A bull bar breaking above that high, and then a good follow-through bar. Chances are we'll get at least a small second leg up, maybe here, maybe pull back here. You can buy the close, you can buy above the high of this bar, above the high of that bar. You can even buy the low of this bar, betting the reversal down will fail. You can buy a bear close, especially a second bear close, thinking that the bears need 3 or more bear closes to reverse this bull breakout. And then you could buy here, a double bottom. Not the same level, but it's still a double bottom. Another reasonable buy above a decent bull bar. You can buy for any reason. The stop for all of those trades, most appropriately, is here or here. Spike, pullback, second push, pullback, third push. This is a potential wedge top, but even here, the market's still always in long. Chances are a reversal will be minor and result in a trading range. It may come all the way down here to the bottom of the channel, breakout, pullback channel, a wedge channel, but it's still always in long. What do you do if you bought down here and now the market is doing this? We have a bear bar and a wedge top, decent reversal here and here, bad follow through after a bull bar here, and again here. We're probably transitioning into a trading range. The premise of a bull trend is no longer valid. It's reasonable to exit with a stop just below the low of this bar. You get filled right there. Alternatively, you could still rely on your stop at the bottom of the channel, hoping that whatever pullback we get becomes a bull flag and the bull trend resumes. One big problem for beginners is they tend to only focus on risk and they ignore probability. And the result is they use stops that are either too tight or too wide, usually too tight. For example, let's say a beginner looks at this price action and he does not want to use a stop that's too tight because he knows he'll lose. He does not want to use a stop that's too wide because he knows he doesn't want to risk that much. And he ends up picking something in the middle. So it's a middle of the road type stop. I call it a dead skunk stop. And in general, it's the worst choice. If the trader did not exit on the reversal down from the wedge, and he was still planning on using this stop down here, he would be concerned by the number of bear bars down, the size of this pullback, and he'd be afraid that maybe the market's converting into a bear trend. Beginners start to panic and worry, and they see, okay, we have 3 bull bars here, this is a major high or low. I can put my stop just below this low. No, it's not a major high or low. It's a reversal up, but is it a very strong reversal up? Look at here and here, and here. Those are strong reversals. Is this a strong reversal up? Is it a reversal to a new high? No, this is a minor higher low, and putting a stop below a minor higher low is a terrible thing to do, because very often the market will have a first leg down, a pullback, and then a second leg down slightly below the first. The market very often falls below minor higher lows, and then the bull trend resumes. Placing your stop just below the low of that bar, that is a skunk stop, and it's a sure way to lose money. After the beginner failed to get out here, he cannot take the stress. After 5 bars, 10 bars, 15 bars, he can't take the pressure, and he just has to get out, and he'll use any excuse to get out. He'll convince himself that this is a major resumption of the trend up and not simply a leg in a developing trading range, and he'll get out below the bottom, and he ends up selling at the bottom of a trading range. It's never good to sell low in a trading range. You want to sell high, like up here, when you think the channel might be converting into a trading range. Experienced traders, they'll say, okay, it was a spike in channel bull trend, it's transitioning to a trading range. In a trading range, I want to buy low, especially below the low of a prior low. The beginner is selling out of his longs here. The experienced trader is buying at this low, betting that it's a breakout in a trading range and it will fail and the market will reverse up and not the start of a bear trend. Beginners do need to keep their risks small, and therefore they should only take trades where they can use an appropriate stop. For example, a stop beyond the signal bar. If a beginner buys above this bar, betting on a double bottom, slightly higher low, it's reasonable to put his stop just below the low of that bar. An experienced trader can often use a wider stop. However, if the market requires him to use a wide stop, he'll trade small. A lot of times when he's using a wide stop, he'll trade small with the intention of scaling in if it makes sense. Therefore, an experienced trader has many more opportunities to make money. Scaling in increases your probability. It's a trade-off, higher probability, greater risk, but an experienced trader can do that. For example, an experienced trader might buy here, betting that the market's either in a trading range and he's buying low, or it's a bull flag and we'll get a resumption up. But if he buys here, the appropriate stop is either here, we have a strong breakout to a new high, or all the way down here, spike pullback channel, the bottom of the wedge channel. If he's buying here, a lot of traders will buy here and put the stop down here and buy more if the market falls lower. For example, he buys here, he may place a limit order to buy more if it goes to a new low, betting that the market's at the bottom of a trading range and not in the early stages of a bear trend. He uses his wide stop and he scales in. You can call this a trading range. We don't know what took place here, but let's say it was a bear trend, so you want to call it a slightly lower low, major trend reversal, or a double bottom, major trend reversal, or just a failed breakout below a trading range. That doesn't matter. We have a strong breakout closing above the high of the past 30 bars, and a follow-through bar, a follow-through bull bar closing above its midpoint. Chances are the market's going at least a little higher. Bulls can buy for any reason. They can buy the close. They can buy below the bear bar, betting the failed breakout will not reverse the trend, and that there'll be buyers below that bar for at least a small second leg up. You can buy above a high 1 bull flag, a pullback from the breakout. For whatever reason you buy, the stop is obvious. It's below the bottom of the bull breakout. Strong bull breakout, 60% probability the market's going to rally for a measured move up. 60% chance it's going to rally to here, which is the distance from the entry price to the stop. The stop is actually just below the bottom of the bull breakout. But in any case, 60% chance this low to your entry price, you'll get a measured move up to here before you get stopped out below. Deep reversal increases the chances that, instead of a bull trend, the market's now in a trading range. But in any case, chances are the market will come back to the top of the range before it hits this stop. The market's probably still always in long, despite 4 consecutive bear bars, because it's still a pullback from this strong bull breakout. Reasonable to stay long and rely on your stop. Some traders will exit on the big breakout or on the close of the follow-through bar, and then look to buy on a reversal up. And this is what we got in this particular case. A deep pullback after a strong bull breakout, and then a very strong bull trend. Is it forming a triangle or a lower high for a bear trend? Sure. However, I think we're still always in long. We're still above the bottom of a very strong breakout. The traders who did exit over here on the close of the follow-through bear bar are looking to buy again. They could buy again above a bull bar here, or above a bull bar here, or above this inside bar here. If this was a bear trend, this is a higher low major trend reversal. If this was simply a trading range, this is a breakout and a pullback. Another reason to buy, looking for a reversal up. I talked about what happens after a stop is hit. In general, there's a 50% chance that the breakout will lead to a swing, and there's a 50% chance that the breakout will fail and reverse. I also talked about how it's important to use a logical stop, one that is not too small nor too big. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 7 videos on protective stops. Most traders begin using price action stops, stops based upon the bars on the chart and the patterns on the chart. I want to talk a little bit about how a bull trend needs higher lows. They're more important than higher highs because bulls put their stops below the most recent major higher low. If the market falls below that major higher low, traders assume the bull trend has ended and the market has entered either a trading range or a bear trend. When you're in a trade and you have a stop and the market goes your way and it makes a strong breakout, traders will often raise their stop to below the most recent higher low. That is called trailing your stop. And the same is true in a bear trend as well. And I'm going to talk a little bit about stops in a bear trend. We have a bear trend, a rally. I don't have the trend line drawn, but it's a rally that broke above the bear trend line. And then we have a pullback to a higher low. And now we have a strong breakout, 5 consecutive bull bars, 2 with good sized bodies closing on their highs. This is a higher low major trend reversal. Since there is a left shoulder over here, it's also a head and shoulders bottom. The market is always in long and probably will go higher. Whenever you look at a signal bar that is possibly the start of a strong leg up, traders will put the stop right below the signal bar low. For example, if they buy above this bar, they'll put the stop below its low, especially once we get a strong bull breakout. On the other hand, sometimes you'll buy above a signal bar and you're not sure that it's the end of the pullback and the pullback may continue to grow. In that case, you put your stop below the most recent major higher low. For example, we have a buy signal bar here for a high 2 bull flag, 2 legs down, 1 pullback 2, but the body is small compared to these 2 big bear bars. These 2 big bear bars are strong enough so that the market might have a second leg down, 1 pullback 2. If you buy above the high of this bar, you get long here. In general, you should not put your stop here. There's too much risk that the market is going to go below that low, as it did here, yet still remain always in long. It'll still fail to get below the bottom of the most recent major higher low. This is a major higher low because it's a strong rally and it went to a new high. If the market falls below this low, traders will question the premise that the market is now in a bull trend. They'll assume that it is either in a trading range or possibly even a bear trend. High 2 bull flag, here's the buy signal bar. It's okay to buy above its high, get long here. Higher probability to buy above this bar. If you take this buy above this buy signal bar, I would put the stop here. You could put your stop here and then buy again on the reversal up from here. However, you end up losing your entry price to your stop price. It's better to simply rely on the wider stop and trust that you're correct, that this is a bull trend and this is a bull flag, but it might pull back a little bit more. Traders can buy for any reason. We're always in long. They could buy on a stop just above this high and get filled right here. We have a breakout bar here, big tail. Okay to buy the bull close of this bar. A bull close is good follow through. You could also buy above the high of this bar. You could buy a high 2 buy, high 1, high 2, and now we have a second entry buy for that high 2 bull flag here. We have another breakout and follow through bar and a pullback, another bull flag. You can buy above the high of this bull bar. It doesn't matter where you bought. All of these trades have the same stop, below the most recent major higher low. A strong breakout to a new high. This is a major higher low. If the market falls below it, the premise of a bull trend is no longer valid. Therefore, this is a reasonable place to place your stop if you're betting that the market's going to go higher. Whenever you're buying later in a bull trend after a strong breakout, the stop is further away compared to buying here or here, but the probability of higher prices is higher as well once you've had a strong breakout like this with good follow-through. A bull trend needs higher lows and higher highs. It especially needs major higher lows. If the market's no longer making higher lows, then the premise of a bull trend is no longer valid. It's probably either a trading range or possibly even a bear trend. Bulls like to put their stops below the bottom of the most recent strong bull leg. This is a major higher low. We've had 8 bars up without a bear body. This is an important higher low. It's a buy the close bull trend. You could buy closes here, any of these closes. Let's say you bought here. You could buy for any reason. You could buy at the market, you could buy a close, you could buy above this bar, you can buy at the low of this bar betting the reversal down will fail. It doesn't matter. Anyone buying for any reason through here has the same stop, below the bottom of the major higher low. It doesn't matter where you bought, anywhere after this close, all through here, traders use the same stop, below the bottom of the most recent major higher low. I mentioned a couple times here that bulls need major higher lows. If you buy here, your stop is here. If the market falls below this major higher low, it's probably no longer in a bull trend. You could get out below this bear bar and then look to buy again above a bull bar. It did not get above this bull bar, but it did get above this bull bar, so you could buy again right there. And once there's a strong rally, especially one that goes to a new high, but not always, sometimes the strong rally does not quite reach the major high, traders will raise their stop from here to below this low because they'll consider this a major higher low. If the bull trend is still intact, it should not fall below the low of this strong bull breakout. That's trailing the stop from the original location to a new location. This might be a higher low major trend reversal. We don't see the bars to the left, but let's assume that it was a bear trend, this is a rally, and this is a higher low major trend reversal. Doesn't matter. It's still a bull trend whether or not there was a bear trend before it. It could have simply been a breakout of a trading range. We have 3 pushes up, 1, pullback, 2, pullback, 3, pullback, a new high, this is slightly above that, and we have a bear reversal bar, a bear inside bar. This is possibly a failed breakout. Strong enough breakout, traders will buy the close. They'll buy for any reason. They'll buy at the market, they'll buy on a stop above the top of this leg up. Because it's a third push up, and a possible failed breakout, and a strong bear bar closing on its low, this is a possible wedge top. And it could be the end of the rally. You have several choices here. You can exit below the low of this bear bar, and then look to buy again if there's a bull bar and a reversal back up. Other bulls will rely on their stop below the bottom of the most recent higher low, betting that any pullback, even if it's deep, will convert the bull trend into a trading range instead of a bear trend. In other words, the market will stay above this low and test back up to this high. And the final choice is you could simply rely on your earlier stop. This is an especially strong rally and the start of a bull trend. And sometimes the market may have an ABC pullback, A, B, C, where C falls slightly below this low, but not below the bottom of the bull trend. All 3 choices are reasonable. And look at what happened here. Let's say you did exit below the low of this bear bar. You're looking to buy again above a bull bar on a reversal up, but this low is slightly below that low. For the bulls who tighten their stop from here to below the low of this bull leg, they get stopped out here. And that's okay. They can buy again on the reversal up. Some bears would take that short. It's a wedge top and a strong bear bar closing on its low. I think it's a good location to exit the longs. Typically in a situation like this, a wedge top with a good sell signal bar, I would exit below that bear bar, exit my longs. Some bears would short. With 3 bull bars closing in their highs, I typically would not take that short. I think a minor reversal in a trading range is more likely than a bear trend. Some bears do take that short, and it is a reasonable short. We have a strong bear reversal, 2 big bear bars reversing these 3 bull bars, big up, big down, big confusion. Usually a trading range is likely, but a wedge, 1, 2, 3, typically has 2 legs sideways to down. 1, pull back 2. It's still above the bottom of the bull trend, even though it fell below this low. It could simply be a 2-legged pullback, 1, pullback 2, where the pullback went above the top of the bull trend. It could be a double bottom bull flag, which is a large high 2. Leg 1, high 1, and then pull back, and then possibly leg 2. Still above the bottom of the bull trend, still a possible higher low compared to this. It's obviously below this. It's still a possible broad bull channel, where you have a rally and a deep complex pullback, sometimes even going always in short, but then a new high, and then another higher low, and a new high. For the bears, they see a wedge. 1, 2, 3 pushes up and a reversal. They're expecting at least a second leg sideways to down after a reversal this strong. Whenever I see big up, big down, and a buy signal bar like this, I often do not take that buy. Because big up, big down creates big confusion in a trading range, I usually wait for a second entry buy. You can see the market went above the high of this bar and then immediately went below it again. This is a second entry buy. It's still above the bottom of the strong bull trend. Buying above this bar is a higher probability buy than buying above this bar. I would use the same stop for both. Had I bought above here and got filled here, or bought above here and got filled here, my stop is still here. We had a reasonable buy here, pretty strong rally. I think it's reasonable to be long here. The market never gave the bulls a chance to get out. Immediately there was a disappointment bar, and we did not get any bounce up to this close. A trader buying this close and managing his trade properly using a correct wide stop and buying again above a bull bar, either above this bar or above this bar, or maybe above this bar, usually is able to avoid a loss. This reversal down is still above the bottom of the bull leg. I think a trading range is more likely than a bear trend. And if it's a trading range, it goes down, but it also goes back up. If you take a reasonable buy, buying a strong bull close and a bull trend, usually the market will let you out without a loss if you manage your trade appropriately. Some bulls will rely on the wide stop, the bottom of the initial very strong rally, and they'll look to add on above a bull bar, either here or above this doji or above this bull bar, expecting a trading range instead of a bear trend. The bulls who did exit below this bear bar know that it was reasonable to buy here, and therefore it's reasonable to buy more either here or here. The bulls who exited below this bear bar will buy here or above here, expecting the market to get back up here. And therefore it's reasonable to buy above a bull bar here or here. And you can see that if a bull bought here and used this stop, he would have made money. If a bull exited below this bar and bought more either here or here and used this stop, he would make money. If a bull exited here and he bought here for a test of this close, he would make money. He could also hold for a swing up. We have a double bottom. This is slightly below that. If you want, you can call it a lower low, major trend reversal. Bear trend, a lot of good bull bars, good buying pressure. An attempt to resume the bear trend, but immediately reversing up with a pretty decent bull bar. Good sized body closing above its midpoint. It's reasonable to buy on a stop above the high of this bull bar, and you get filled right here. It's a strong buy signal bar on the reversal up. It's appropriate and reasonable to put your protective stop just below the low of this bull bar. That is a price action stop. You're putting a stop based upon the price action, right below the bottom of a buy signal bar where the context is good for a possible swing up. Strong breakout and a follow-through bar and another follow-through bar. Chances are there'll be at least a small second leg up. It might be this, it might be this. It could be many legs up, and we could go for a swing. We're rallying, we're pulling back, and then we have a bull bar here. Some bulls would buy above the high of this bar, a failed low 2, low 1, low 2. Other bulls prefer to buy above bull bars, and they'll buy above this bull bar and get filled here. It doesn't matter if you bought here or here. Look to the left. Where is the most recent major high or low? Is this a major high or low? No, it's minor. We could easily continue down more. Is this a major high or low? No, it did not have a strong breakout to a new high. This is the most recent high or low. It doesn't matter whether you bought here or here. The stop for both entries is still here, below the bottom of the most recent bull leg. Once you've had the breakout, 4 consecutive bull bars to a new significant high, above the top of the most recent major lower high in this case, traders will raise their stop. They'll trail their stop from here to here. So once the market is up here, it does not matter whether you bought here, or for any reason, once the market is here, traders have a protective stop here. This is now the most recent major lower high. You could argue that it's still fairly minor and that you could rely on a stop down here, but most of the time when you have a strong breakout to a new high with follow through, the market will not come down to this low. So it's reasonable to put your stop just below that low. Another high 2 bull flag, 2 legs down, 1 pullback 2. Good looking buy signal bar. It's appropriate to buy on a stop above this high. And it's a good enough buy signal bar with bull bar here, bull bar here. It's a breakout test of the breakout point here, a test of this gap, a gap between this low and that high, this low and that high, this low and that high. Once you get filled on a long above here, it's reasonable to use a price action stop, a stop right below the bottom of this strong bull reversal bar. If the bull trend is valid and if the market is going higher, once you go above this bull bar, it typically would not go below its low, and therefore it's reasonable to put your stop here. And again, it doesn't matter if you bought here or anywhere down here. Once it goes above this bull bar, most traders would tighten their stop to just below the bottom of that bull bar. That is a price action stop. A small double bottom, a high 2 bull flag, a fairly tight trading range. If you take this buy above this bar, I think your stop is still here. But once this bar closes, you have a new breakout to a new high. It looks like we might be entering a trading range. I think once this bar closes, you do not want the market to come back below the low of this bar. Otherwise, the market might be in a trading range instead of a bull trend. It's reasonable to use a tighter stop. We're getting trading range price action here. The market might be evolving from a bull trend into a trading range. And ultimately, it did. It just had further to go before the reversal down. If you buy above this bar, your stop is here. By the time the bar closes, I would trail the stop here. If the market's going to evolve into a trading range, you don't want to be using too wide of a stop. You want to begin to trade it like a trading range. Buy low, sell high, and scalp. 2 legs down, a bear bar, bull bar, so first leg down, and then 2 bear bars, second leg down, reversal up, good looking bull bar. You can buy above its high. I would put the stop here just in case we get a wedge, 3 legs down, 1 pullback, 2 pullback, 3. But once you break to a new high, traders will raise their stop maybe to here. Another high 2 bull flag, high 1, pullback, high 2, stop either here or here. I would put the stop here. We're getting a lot of small bars, prominent tails. Chances are the bull trend will end soon and evolve either into a trading range or a bear trend. Weak breakout. We have a bull bar and a follow-through bar, but a tail and the bar is not big. We have a doji bar here. We have a bull bar here, a breakout, and follow-through. The breakout bar is not big. We have a pair of dojis. It looks like from here on, we're starting to get a lot of trading range price action. Traders will, instead of waiting for stops to be hit, assume that the market is in a trading range. Trading range, buy low, sell high. And sell high also means sell out of longs high on a reversal down. Traders will switch from using price action stops at the bottom of the most recent bear leg to selling a reversal down from a new high. A new high, traders will exit just in case it becomes a trading range. They buy here, we have a new high above here, and we're reversing down. The bulls will sell just in case it's the start of a trading range or even a bear trend. You can call it a wedge, 3 pushes up, here, here, and here. It's actually 4 or 5 pushes up. 1, 2, 3, 4, 5. You can even count this as a push up as well. In any case, we're getting a lot of pushes up, and here we have a gap that stayed open, this low and that high. And then here we have a gap that either stayed open or maybe there's a little bit of an overlap. So bears selling above this high did not make money. Bears selling at this high made money. Bears selling at this high might have made money. If they sell this high, sell a little bit more higher, they might have scalped. We're getting overlap, stairs, pullbacks are falling below breakout points. Breakout, a pullback below the breakout point. The market's starting to transition into a trading range, and therefore, instead of exiting on stops below the bottom of the most recent bull breakout, it's better to exit on a reversal down from a new high. The price action stop here is below this bar, not all the way down here. Bulls will exit. Aggressive bears might start selling using a very wide stop. I think it's still a fairly tight bull channel, and any reversal is probably going to be minor, followed by a trading range or a resumption of the bull trend. However, once you get 3 or 4 bear bars, especially a pair of big bear bars closing on the lows, the market has probably converted either into a trading range or a bear trend. And after 3 or 4 bear bars, 2 of them closing on their lows like this, traders will start selling this close and putting a stop up here, bidding on at least 2 legs down. I mentioned trailing stops. I'm going to talk a little bit more about it now. We have a double bottom, slightly lower low, and we have a breakout and a follow through. Traders will start buying closes here or here. After each breakout to a new high, if the breakout is strong, traders begin to raise stop, to trail their stops, to protect their profits, reduce their risk. Traders usually like to raise their stops to below the most recent major higher low. If the breakout is strong, the prior higher low can be major. For example, if you're buying here, your initial stop is down here. Maybe you'll put your stop here because we have a pair of breakout bars. In general, you're looking for a reasonable stop. Some traders will put a tight stop here. Other traders will use a wide stop there. Both are reasonable. If you use a tighter stop, you're going to lose more often, but you'll lose less per loss. If you use a wider stop, you're going to lose less often, and you'll lose more every time you lose. But after 100 trades, it doesn't matter if you use tighter stops or wider stops. Your net profit and your total losses will be about the same. The key is doing something that is reasonable. If you use a stop that is far too tight, you're going to lose money. It's a losing strategy. If you use a stop that is far too wide, you're going to lose money. Can you put a stop below the low of this breakout bar, arguing that if it falls below this low, the breakout will have failed? That's a fairly tight stop. Probably better to put a stop below here, the bottom of the bull leg, or even down here. Both are reasonable. Some traders will buy here and say, well, it shouldn't fall much below a 50% pullback. I'll put my stop right below the midpoint of the rally, the bottom of the rally, the top of the rally, or the entry price, and this is just below the midpoint. Other traders will put a stop here below the bottom of the bull trend. This is really a major higher low. This is minor. We could pull back more and still be in a bull trend. This is minor as well. We have a reasonably good breakout to a new high. Is this major? Typically, if the breakout is good and the trend will continue, it should not fall below here. So it's reasonable to put a stop here as well. But sometimes when you have a bull trend, you get a very deep pullback. Therefore, it's better to use a wider stop. You lose more when you're wrong, but you have a higher probability of making money. All of these stops are reasonable choices. And if you take 100 trades and use any of these 4 types of stops, the total profit after 100 trades will be about the same. I want to talk a little bit about stops in a bear trend. I was using a bull trend to illustrate examples of how to use stops. Let's say there was a bull trend here and we don't see it, and then we got a small higher low major trend reversal here, and you sell below that bear bar and you get filled. This might be a little bit below that bar, so you either get filled here or here. You could put your stop right above that high. In general, I would use a wider stop. And it's reasonable to put your stop above the top of that bear reversal bar. That's a price action stop. In general, if you have a small signal bar and you put a stop above its high, it's a low probability bet. Whenever you are risking very little, the probability of success is much less. Chances are if it goes above this bear bar, it's probably not going to go much further. Some traders would prefer to use a wider stop, maybe up here, maybe a measured move up based upon the height of these bull bars. But let's say, for example, you put your stop above the top of this sell signal bar and you sold below its low and you got filled here. Other traders will wait for a bear breakout and then a pullback and sell below its low. Here we have a double top. We're up and down, up, maybe down. Traders will sell below here. It's a low 2 bear flag after a bear breakout, a reasonable swing trade. You can sell here or you can sell here. If you do, your stop is still up here at the top of the bear trend or possibly above the top of the strong bear breakout. After every strong breakout like this, especially one to a new low, a lot of traders will put their stop right above the top of that big bear bar. If it's very close to the top of the bear trend, I typically keep my stop at the top of the bear trend because sometimes it'll go above the top of the bear bar, but not above the top of the bear trend. Strong breakout to a new low. If this is a bear trend and not simply a trading range, the market should not get above the top of this bear swing. This is now a major lower high, and most bears would put their stops above the high of this bar right here. Every strong breakout to a new low means the top of the bear leg is a major lower high. As long as the market is making major lower highs, it's still in a bear trend. If it goes above the top of one of those major lower highs, your premise of a bear trend is no longer valid. The market is no longer in a bear trend. It's either in a trading range or in a bull trend. And therefore, if you took a trade based upon the idea that the market was in a bear trend and the market is showing you it's not in a bear trend, you get out. You get out when your stop is hit. 3 big bear bars, 6 or 7 bars down, a breakout to a new low. If this is a tight channel, bear trend, the market should not get back above this high. It's reasonable to put your stop above this high after you've seen this breakout and this follow through. 3 new bear bars. Once the market is down here, traders will put their stop above the top of this bear leg. This is a major lower high. It doesn't matter if you sold up here, or for any reason. If you sold this close, the stop now is above the top of this strong bear breakout. Another strong breakout to a new low. Once the market is here or here, no matter where you sold, your stop is now here above the top of that bear leg. The market's in a very tight bear channel, and we have a bear breakout here, another one here, another breakout here, another breakout here. And what do you notice about this bear breakout? It's the biggest bear breakout occurring 20 or more bars in a bear trend, and it's breaking below the bottom of a bear channel. 75% chance if you break below the bottom of the bear channel, you're going to reverse up. Whenever you see the strongest bear breakout, 20 or more bars late in a bear trend, that breakout is going to be an exhaustion gap. Right now, the gap is between this high and this low or that low. 75% chance we're going to get back above this low. This is probably an exhaustive end of the move, not an acceleration of the move into a stronger bear trend. Because once you see this exceptional bear breakout late in a bear trend below the bottom of the bear channel, and you know the odds are the market's going to get above the top of the bear breakout, you don't put your stop here anymore. You exit on a reversal up, especially above a bull bar. We have a bull bar here. It's okay to exit your short above the high of that bull bar. Other traders will wait to see if we get 3 consecutive bull bars, especially 1 or 2 having strong bull closes, and then they'll exit on that bar. And the bulls know the situation as well, and they'll buy. They'll buy above this bull bar or above this bull bar, or on the close of the 3rd bull bar, betting that the market is going to get to the top of the sell climax before it gets to a new low. Strong bear breakout, traders will sell closes. They'll sell that close. Let's say you sold the worst close right here in this breakout. That's okay. It's okay as long as you use the appropriate stop. After every new low, traders look to trail their stop, tighten their stop to reduce their risk. You could still use a stop way up here, but if the trend is truly going to continue, it should not get above the top of the most recent strong bear breakout. It makes more sense to tighten your stop to above this lower high. If the stop is too far, it's not too far here, but if it is too far, a lot of traders will find other reasons to exit before the market hits that distant stop. For example, they might put a stop just above a 50% pullback. You often hear traders talk about using a break-even stop. There's no mathematical basis for a break-even stop. In general, it's not a good stop. Sometimes it makes sense to use because you don't know what to do and the market's moving fast and you don't want to risk giving back any profit So emotionally, it's often a good decision, and therefore sometimes it is a good decision, but there's no mathematical basis to a break-even stop. If you're being totally objective, you're never going to use a break-even stop. Again, it doesn't matter what stop you use as long as it's reasonable. Tighter stops lose less every time you lose, but you're going to lose more often. Wider stops have a smaller probability of being hit. You have a higher probability of making money if you use a wide stop. When the stop does get hit, your losses will be bigger. After 100 trades, if you like tight stops, you'll lose about the same and win about the same as a trader who likes wide stops. As long as both choices are reasonable, it does not matter which you take. For example, it's reasonable to put a stop above the top of this bear breakout. It's also reasonable to put the stop above the top of the entire bear leg, above this lower high. Some traders will look at the entire bear trend and say, I don't know, I could easily get above this bar, form a higher high double top, and resume down. Maybe I want to put my stop above the top of the entire bear trend. If that's too far, maybe instead I'll simply put my stop above a 50% pullback, which is here. Top of the bear trend, bottom of the bear trend, 50% pullback here. Maybe I'll put my stop a little bit above the midpoint. And then some traders will keep their stop above the top of the entire bear trend. A tight channel like this is going to be a breakout on a higher time frame, and keeping the stop here is simply putting your stop above the top of the bear breakout. Again, these are all reasonable stops, and therefore any of them is good. If you sell this close and you put a stop above this bull bar, that's probably not reasonable. Chances are you're going to get a pullback, but the bear trend will continue down. You do not want to use a stop that's too tight. You don't want to use a stop that's too wide. Both of them result in losing strategies. I began by talking about a price action stop, a stop based upon the patterns that you see on the chart. I made the point that bull trends need higher lows, major higher lows. If the market falls below a major higher low, it's no longer a bull trend. It's either a trading range or a bear trend. If you are in a trade and the market moves in your direction and you have a new major higher low, you can raise your stop to below that major higher low. Moving your stop is called trailing your stop. I then talked about stops in a bear trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This was the third of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 7 videos on protective stops. For a trend to continue, it has to respect prior pullbacks. It needs to continue to make trending higher highs and higher lows. At some point, your premise will change. For example, if you're holding a position and you believe you're in a trend, but the market price action tells you that is no longer likely, then you have to change how you're trading the market. We clearly have a bull trend with higher lows and higher highs, and whenever the market's in a trend, you can always draw lines that contain the price action, a bull channel. A trader who's buying or is long is holding his position on the theory that this is a bull trend. As long as the market is continuing to make major higher lows, then it's continuing to be in a bull trend. For example, this is a minor higher low. The rally that followed it was only very brief, and the market fell below it, but it did not fall below this low, a strong breakout to a new high. This is a much more important higher low. This is minor, and if the market falls below it, a trader is not going to change his opinion that the market's in a bull trend. He'll still believe it's a bull trend, and he'll believe that the pullback is simply more complex. After every strong breakout, especially a strong breakout to a new high, traders will raise their stop to below the most recent higher low. That is a major higher low. If the market ever falls below a major higher low, then the premise that the market's in a bull trend is no longer correct. The market has then evolved into either a trading range or possibly even a bear trend. Here we had a strong breakout to a new high. We have a major higher low. Yet we had a strong reversal down that broke below this higher low. Once the market does that, do you still believe the market's in a bull trend? It might be in a much broader, flatter bull channel, but most traders would look at this and say, the bull channel now has evolved into a trading range, possibly even a bear trend. It broke below the channel, the trend line. Bears will start looking for lower highs to sell, hoping for a series of lower highs and a bear trend. For example, a lower high major trend reversal. Not high probability after 3 bull bars, 2 of them being big. More likely big down, big up, big confusion, and sideways. Is this a minor or a major higher low? I would call it a major higher low. We have 3 bull bars closing near their highs and we have a new high. However, I also think that we've had several pushes up. We're getting near the top of the channel. If we do get a reversal down, the market might start to form a trading range. In any case, if the market falls below this low, probably the market is going to go sideways. Big up, big down, big confusion. This might be minor in the eyes of some traders. The bars are not all that big. And as I said, this two-legged pullback is still above this higher low and above this low. The bulls still might be in a very broad bull channel. We had a strong pullback after an initial very strong breakout, and we've trended up since then. This is a more important higher low than this. This is, I think, major enough so that bull swing traders will conclude the market's probably in a trading range. But some traders will look at it as minor, and maybe we're just pulling back to a large wedge bull flag, and we'll get trend resumption up. This, I think most traders believe, is a strong attempt by the bears to reverse the trend, and the bulls reversed up strongly instead. This is a very important higher low. Most traders would view this as very important. Some would view this as important. Others would view it as minor. We have a spike pullback channel, 3 pushes up, 1, 2, 3. We also have maybe a 30 or 40 bar very tight bull channel coming from this low. If the market falls below this low, the final bulls will give up. And that's what took place with these 2 big bull bars. The bulls believed it should not have fallen below this low if the premise of a bull trend or even a trading range was intact, and by falling below that low, the final bulls gave up. Some gave up below this low, over here, and then others gave up here, but they bought this low. You can see we pulled back. However, once it fell below this low, the market collapsed. The final bulls gave up on the premise of a bull trend. Some bulls gave up here, others gave up here, possibly minor higher low, possibly a 2-legged pullback, 1, 2, bulls trying to buy here, but everyone agreed that if it fell below this higher low or this higher low, then the bull trend is no longer valid. The market's then either in a big trading range or in a bear trend. And you can see the give up bars, the very big sell-off, and that represents the final bulls deciding that their premise of a bull trend is no longer valid. In fact, their premise of a bull trend or possibly a deep pullback in a trading range is no longer valid once it fell below that low and that low. Very strong breakout, follow through. Chances are the market's going to fall for some measured move down. The market's always in short. Traders are selling for any reason. And they'll sell the first rally, betting that we'll get at least a small second leg down after a surprise breakout like that. A bear trend, we have lower lows. More importantly, we have lower highs. You can draw a trend line across the top of the channel. You can draw a line below as well. As long as the bear trend keeps getting strong breakouts to new lows, traders believe it's in a bear trend. If it rallies above one of the major lower highs, traders will conclude that the premise is no longer valid. It's no longer a bear trend. If it's not a bear trend, then it's either a trading range or a bull trend. Is this a major lower high? We have a breakout and we have a new low. However, the breakout is not particularly strong. Some traders would consider this to be relatively minor, and therefore, if the market goes above it or a little bit above it, they'll say that maybe we're still in a bull trend. This is more important. We tried to reverse up strongly. We got a double top bear flag. We have a persistent sell-off lasting about 30 bars. This is, I think, a more important lower high. A weak bear breakout, if it goes above this high, it's not necessarily clearly bullish. It's less bearish, but not necessarily clearly bullish. When I get a reversal up from a weak sell-off like this, especially when we're still in a bear channel, We're still below the bear trend line. The first reversal up is probably minor, which means either a bear flag or a bull leg in what will become a trading range. If the market is converting into a trading range, traders will switch how they're trading. They'll look to buy low, sell high, and scalp. They'll no longer hold short for swing trades. They'll take profits at new lows, betting that the breakouts will not fall very far. And they'll sell rallies, betting that the bulls will be unable to get a reversal. Bulls will buy at prior lows, betting that the bear breakouts will fail, and the market becomes a trading range because traders are buying low. Both bulls and bears buy low, and both bulls and bears sell rallies. Neither one holds on to positions long because they think the market will not go very far up or down. And the result is the market goes sideways. We're sideways here, a double bottom, a little bit of a wedge pullback, 1, 2, 3, and then a double bottom here. A surprise bar, a big bull trend bar, and a follow-through bar. We're probably always in long, and we'll probably get at least a small second leg up. 1, pullback, 2. If the market rallies above a major lower high like this, the bears will give up, and the bulls will get very confident, and the result could be a bull trend. Double bottom with this low and any of these lows, a double bottom and a higher low after breaking above the bear trend line, so a double bottom, higher low, major trend reversal. The bars are small, we're in a tight trading range, no sign that the market's going to go very far soon. However, it's reasonable to start to buy, maybe above a bull bar like this. Lots of small bars, the market's going sideways, lots of reversals, bad follow through after bull bars and bear bars. The market thinks this is an appropriate price. Both bulls and bears are satisfied with this price. However, every trading range is followed by a breakout, and if there's a strong breakout with follow through, the bear trend will probably evolve into a trading range or possibly even a bull trend. If there's no strong breakout and follow through, you have to assume every breakout will fail. A bear breakout, bull attempted a breakout, and then bears, bulls, bears. We have a bull breakout and follow through, a pair of bull bars closing above the high of the past maybe 50 bars or so. Good for the bulls. It's not especially strong. The bars are not all that big relative to what we've had over here. And the follow through, instead of being a series of very big bull trend bars, is a series of small dojis. This is a weak rally, and probably this entire rally will end up as a bull leg in what will become a trading range. We're attempting to reverse up from a lower low, and then we sold off to a new low, sold off for maybe 15 bars, and we had a big bear bar. This is, I think, an important lower high. If the bears are going to continue to believe the market's in a bear trend, they do not want the market to rally above any major lower high, because then their premise of a bear trend is no longer valid, and they'll have to switch how they're trading. So instead of trading like a bear trend, they'll trade like a trading range or a bull trend. 10 or more bars to a new low, pretty good bear bar, pretty good bear breakout. We have lots of reversals in here. A higher low here, a lower high here, and even here we have a higher low here, a lower high here. Most of these reversals create minor lower highs and lower lows. You can see, even going down, going up, we're just not getting good follow through either way. This entire sell-off looks like it's a bear leg in what will become a trading range. This rally, the absence of consecutive big bull trend bars, probably a bull leg and a trading range, and that's true all the way here. The only clearly strong lower high, major lower high, is here, maybe here. Some computers will consider this major. Most computers will not consider these as particularly major. And if the market breaks above these lower highs, probably the breakout is not significant. It's probably not changing the market into a bull trend. There's another problem with this lower high that makes it really not all that important. It's not the top of the current bear leg. It's like this, a lower high after the top of the bear leg. This is not nearly as major as this, and the same is true of this. If you're looking for a major lower high, you want it to be the top of the current bear leg, not halfway down. And the same with this. We have a bear breakout, but does not go to a new low. Going above it does not convert the market into a bull trend. Even going above this does not convert it into a bull trend. It weakens the bear case, but probably the market's transitioning into a trading range. Even looking at this rally, bull bar doji, pair of bull bars tail, and then looking at the sell-off, bear bar doji, bear bar bull bar, a bear bar doji, bull bar, bear bar bull bar, all of this trading looks like the market's evolving into a trading range. Trading ranges resist changing into trends. Therefore, if the market breaks above these lower highs, even with a relatively strong breakout like this or like this, it's probably simply a bull leg in a trading range. The bear trend has evolved into a trading range. It has not turned into a bull trend by simply going above minor lower highs. Here, we closed above the top of the entire range. This, I think, is a major lower high. We got a new low. We're starting to form a series of higher highs, and now we have a breakout and a follow-through bar. This is potentially a gap for a measured move up. The trading range now is converting into a bull trend. Strong bull breakout above lower highs, but not the top of the current bear leg. These are minor lower highs, and that is not enough to make traders believe the market's now in a bull trend. It's probably a bull leg in a trading range. After the bull breakout, look at the bar that followed, the two bars that followed. They pretty much totally reversed the entire rally. And bad follow through after the breakout, that means that more trading range is likely and less likely the start of a bull trend. Strong bull breakout, bad follow through, probably bull leg in a trading range and more sideways. The same right here. Strong breakout above the top of the sell climax, but bad follow through, probably sideways. Here we have a breakout and a bull bar and another bull bar, also a close above the top of the past 40 or 50 bars. The tails on top make the rally less likely to be very strong. However, the breakout is good enough, so traders will expect at least a little bit more up, maybe a measured move up based upon the height of the trading range. Top of the range, we have a double top, and we have a neckline. Instead of falling below the neckline for a measured move down, we're breaking above the double top. Therefore, traders will look for a measured move up. And you can see what happened when the market got around the area of the measured move target. The bulls took profits, and the bears probably started to sell, at least for a scalp. Trends do not go on forever. They eventually change. Trading ranges do not go on forever. They eventually break out. If you're in a trade and you're trading based upon the current price action, but the price action changes, you have to change how you're trading. Let's say you're a bull and you see a 4 consecutive bull bar breakout to a new high, breakout above a wedge top, 1, 2, 3. In general, if you break above a wedge top, 50-50 chance you'll rally for a measured move up, 50-50 chance the breakout will fail and reverse back down. But let's say you bought that close, the 4th consecutive bull bar, but it's also the strongest rally in the entire trend, certainly in the last 20 bars or so, and therefore 60% chance it's an exhaustion move and the market will trade down to the bottom of the buy climax down here. You have to be ready to exit if you bought that close, if you get bad follow through, and you did. This bear bar is terrible follow through for traders who bought that close. If you bought that close, your initial stop is right below the bottom of the breakout, the most recent major high or low. However, after you get 3 or 4 consecutive bear bars closing near their lows, your premise of a bull trend has to change. This looks more like a reversal and an exhaustive buy climax, and if so, 60% chance we're going to get down below the bottom of the buy climax. 4 consecutive bear bars closing on their lows makes a reversal more likely than a continued bull trend. Your premise of a bull trend has changed. Do you wait for the market to hit your stop? Of course not. You no longer believe it's a bull trend. You believe this is an exhaustion gap, this close to that high, and then once this bar closes, this low to this high, this to this high. The market is now probably having an exhaustive buy climax and a reversal down to the bottom of the buy climax. And then it decides whether to fall for a measured move down or go sideways, maybe resume up. Most bulls would exit below that bear bar closing on its low, betting that this is a higher high major trend reversal, bull trend, bear breakout, higher high. especially an exhaustion gap. The strongest bull move late in a bull trend probably is the end of the bull trend, especially if you have this kind of bar following the bull breakout. Aggressive bears will sell, betting that this is the end of the bull trend and that we'll get down to the bottom of the buy climax, and that the breakout above the wedge top will fail. Bears wanting a higher probability will wait until the market has 3 or 4 consecutive bear bars, and then they'll sell the close here or sell the close here and put a stop above here. Higher probability to wait for several consecutive bear bars. But your stop is further away. If you sell below this bar, you get filled here. If you sell the close here, your stop is still here, further away, but higher probability. Reasonable to short either way. Again, whenever you get the strongest bull move late in a bull trend, it's probably going to be an exhaustive move, and the market will probably get down to the bottom of the bull breakout before it goes for a measured move up. Also, whenever you have a wedge top, any place where there's a logical stop, the bears who sold here, their logical stop is above the high of this bar. Anytime the market hits a logical stop, 50-50 chance the market will continue up for a measured move, maybe based upon the height of this range. 50-50 chance the breakout above the stop location will fail and the market will reverse down. You can think of it as consecutive tops. We had a wedge top, failed, and now we have another top, an exhaustive buy climax top. A triangle, you can simply call it a tight trading range. If you want, you can call it a triangle. 20 or more bars long in a bull trend often becomes the final bull flag. If there's a bull breakout, the market tries to come back to the middle of the triangle. We know that there's a 60% chance the market is going to come all the way down to the bottom of the buy climax when you get that kind of a follow-through bar. Maybe a trading range, maybe a bear channel. In any case, we have a bear breakout closing far below this low, and then we have a follow-through bar as well. 2 legs down, measured move down, likely. Because of that, some bears will sell that close and put a stop above the top of the current bear leg. This is a very tight bear channel. It looks like a 7-bar bear microchannel, and that means that the bears are strong. They'll sell the first reversal up. The first reversal up will therefore be minor and lead to either a trading range or a bear flag. The bulls can argue a wedge, 3 pushes down, 1, 2, 3, parabolic wedge. They can also argue this doji is a pause from this breakout and the start of a second leg down. This breakout and follow through are strong enough so the market will probably have at least a second leg down, and it's possible that these 2 bear bars represent the end of that second leg down. Some bears will look at this and say, okay, we have 6 good bear bars, 8 bars in the bear channel. Chances are the first reversal up is minor, and therefore I'll place a limit order to sell at the high of the prior bar, and I would get filled here, betting that the reversal up is minor, and it will become a bear flag, or simply a bull leg in a trading range. The bears who did sell do not like this bull bar closing on its high and having a big bull body. Therefore, they're wondering if the parabolic wedge is taking control of the market. 3 reversals up, 1, 2, 3. This might have been the entire second leg down after this first leg down. Rally continuing. Now we have 4 bull bars, 3 with decent-sized bull bodies. Some bears will sell at a 50% pullback of the bear trend. Top of the bear trend, bottom of the bear trend, 50% pullback. 4 consecutive bull bars closing near their highs. Possibly we've already had the second leg down. However, very tight bear channel, the first reversal up, probably the best the bulls get is a trading range. Also, big down, surprisingly big up. Big down, big up creates big confusion. Big confusion is a hallmark of a trading range. Probably the market's going to go sideways. However, because of the big reversal up, the premise of a bear trend is probably no longer valid. Instead, the market probably is evolving into a trading range. After the 3 bull bars closing on their highs, a lot of the bears will exit, and then they'll wait, just in case this in fact is a reversal that will lead to a bull trend. 3 bull bars in a bear trend, bull bars closing on their highs. Most traders assume there'll be at least a small second leg up. Traders who are short will exit. They'll take the loss. If they sold here and sold more here, they'll just get out here, and they'll look to sell again in a few bars if the market starts to resume down. Aggressive bulls will say, well, we got 3 good-looking bull bars, 2 closing on their highs, both good-sized bodies. Probably the first reversal down will not get very far, and therefore I'll place a limit order to buy at the low of the prior bar, and I'll get filled right here. And these bulls will scale in lower as well, betting that the first reversal down will result in a minor bear resumption, a higher low, and at least a small second leg up. And this is what we got. We continued up. We had a pullback to around 50%, and then a bigger second leg up. Some of the bears who sold this close kept their stop above this high. Sometimes when you have 2 reasonable stop locations, for example here, the top of the sell climax or the top of the bear trend, it's okay to use your stop above either one. A lot of traders will put it above the top of the sell climax. Whenever the market has a big reversal like this, big down, big up, it's probably in a trading range. When the market's in a trading range and there are 2 logical locations for a stop for the bears, and the 2 stops are relatively close, it's usually better to use the higher stop because the market often goes above the lower one, but not above the higher one. So it goes above the lower one and reverses down. I talk more about this in the video on how to trade in trading ranges. Remember, you have some bears who sold here and put a stop above the top of the entire bear trend. Some bears sold here and they get out above this high, but they'll sell again on a reversal down. The scale-in bears who sold here, some would sell below a bear bar here, others would wait for the second leg up and then sell below a bear bar here or here. This is especially good because it went above one resistance level but not above the second. You have some bears selling here and selling more here, stop above the top of the entire bear leg. Many will place a limit order to get out at their original entry price, trying to get out break even on their first sell. Even though the market retraced almost all of the bear trend, they get out break even on this sell. On this sell, they exit here as well, and they make a profit. And you can see when the market got to this original entry price, it bounced. That's a sign that some traders were buying, and some of those traders were bears buying back shorts. I call these scale-in bears. The bears sold here, they added to their position on the reversal down, they scaled in, they are scale-in bears. We have 3 strong pushes down, even below the bottom of this strong bull leg. And now we have an exceptionally strong reversal up. Traders will look to buy the close of this bar, and they'll buy any pullback. For example, above this bar, a high 1 buy, or even with a limit order below this bar, betting that there'll be a second leg up and the reversal down will become a bull flag and not a bear trend. They can buy the close, they can buy with a stop above the high of this small bull flag, a decent looking bull signal bar. The stop is either below the bottom of the buy climax or below the bottom of the entire bull trend. When you buy a close like this, there's always a possibility that the market could pull back very deeply all the way down to below the bottom of this buy climax. If it does, then a trading range is more likely than a bull trend. But if it's trading range, a bear leg will be followed by a bull leg, and the traders who buy here and put a stop here or here probably will be able to avoid a loss and usually are able to make a profit because after that sell-off, we'll have big up, big down, big confusion, trading range. The market probably will trade back up here to create a top to the trading range. We have a strong bull breakout, bad follow through here and again here. Possibly this is a bull leg in a trading range and there could be a very deep pullback. Now we have a wedge, 3 pushes up, 1, 2, 3, or 1, 2, 3. Even though 3 did not go above 2, it's still 3 pushes up. I call that a truncated wedge, where the third push does not go above the second. Computers still treat it like a wedge, and they'll look to sell a reversal down, and bulls will get out on a reversal down. Different ways to draw the wedges. Different computers see them differently. Also 1, 2, 3. Like I said, even though it's a slightly lower high for the third push, it's still functions as a wedge. It's 3 pushes up. Micro double top, a bear inside bar. Many bulls will exit there, betting that it's a failed breakout above a prior high. We're probably evolving into a trading range. We have a wedge sell-off. We have a wedge rally. It's reasonable to exit there, concluding that the premise of a strong bull trend is no longer valid. A trading range is more likely. And now we have 3 consecutive bear bars closing on or near their lows, decent-sized bodies. The bulls have a bull flag, they got a breakout, and now we have a bear breakout. Again, the premise of a bull trend is no longer valid. Probably the best the bulls get is a bull leg in what will become a trading range. And possibly, it could be a reversal, bull trend into a bear trend. After 3 consecutive bear bars, the remaining bulls, many of them, will exit on the close of that bar. And bears will sell as well, betting that the market is reversing and that we'll get down to the bottom of the buy climax, and that the bull trend, in fact, is simply a bull leg in what will become a big trading range. A bull trend has a series of higher lows. If the market falls below a major higher low, then the premise of a bull trend is no longer valid. The market's probably in a trading range or a bear trend. Likewise, a bear trend has a series of lower highs. As long as pullbacks respect major lower highs and do not go above them, the premise of a bear trend is still good. The market is still in a bear trend. If it gets above a major lower high, the market probably has evolved into a trading range and possibly has reversed into a bull trend. Anytime you're taking a trade, you're taking it based upon a belief, a premise. For example, if you're buying in a bull trend, you believe the market's in a bull trend. Trends do not last forever. If your premise of a bull trend is no longer valid, do not continue to trade the market like a bull trend. Exit and then reevaluate what to do. The same is true for a bear trend. If your premise of a bear trend is no longer valid, exit and then look for your next trade and trade in a way that's appropriate for the current market condition. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 7 videos on protective stops.